So each trigger, essentially what it represents is an emotional point in which bears or bulls take control over the price action. And so you have it on the 1 minute, which isn't really extremely meaningful. It starts getting a little more meaningful in the 5 minute time frame and the hourly time frame. So if we just look, this is as far back as TradingView will let me go on the 1 minute chart. So this is, a perfect place to start. Of course, the 1 minute trigger is the smallest one. The 5 minute trigger is the one that moves every 5 minutes. Right? Each line
Sorry.
represents. Yeah.
Screen is gone again. Sorry. Screen is gone again.
Okay. So let me.
There we go.
I'll exit and I'll try one more time. How about now?
Yes, it's good.
Okay.
Should be good for everyone. Anybody else who can't see it, exit and come back.
If it goes away, just let me know. Okay, so you have the 5 minute trigger. It moves every 5 minutes, and the 1 minute trigger moves every 1 minute, as you can tell, and the hourly trigger shifts every hour. Now, we can see, just from this chart, the way that I trade using this system, I don't see it done often in the FinTwit community, in traders in general. The way I trade is a very simple method, and it involves an extremely minimal risk compared to possibly a lot of reward. And so I'll explain that right here on the first example that I could possibly give using the SPY chart as far back as TradingView lets me go on the 1 minute chart. So for example, if I had previously been long here, my stop loss would be this 5 minute trigger, right? Because I know that the 5 minute trigger is an emotional battleground. And so once price breaks through the 5 minute trigger, that's when bears are about to take control of the price action. And as you can see, once price broke under the 5 minute trigger, bears took control of the price action. So a really quick example, okay? If I'm long previously on this move higher, right when price closes a 1 minute candle below the 5 minute trigger, this is where I'm going to be stopped. This is where I'm going to stop out of this trade, whether it be a manual stop loss, whether I calculate the delta on my contract, and I know that if price breaks 15 cents, then my contract will move 4 cents, so I'll put my stop loss 4 cents below. But the concept of it is if you're long, once price breaks below the 5 minute trigger, you don't want to be long anymore. And now, let's say I wanted to go short on the break below the 5 minute trigger. So as soon as I go short, over here it would have been 1 minute candle close below the 5 minute trigger. So it would have been 392.30. At this point, my stop loss is a 1 minute candle close above the 5 minute trigger. Now, if we change it to line, you'll see that, price never closed above the 5 minute trigger. So some people like using lines, some people like using bars, candles. It doesn't really make a difference. Just try not to get faked out in scenarios like this. For example, if you were short on this break below and you see price breaking above the 5 minute trigger for a second, you're like, oh man, let me get stopped out of my short because it's about to explode back up. No. You always have to wait for the candle close because you have a lot of fake outs like this. So that's just important to keep in mind. So if we were going short here on the break below the 5 minute trigger, our stop loss would be any 1 minute candle close above. And as you can see, even if we didn't sell in any of these points, we wouldn't have gotten stopped out all the way until 389.52. And we went short at 392.48. That's a huge gain. So when you add velocity into the mix, how does that help? What can that tell you? So right now on the bottom, the thick blue is hourly velocity, or purple. The lighter color is 5 minute velocity, and the gold is 1 minute velocity. So I'm going to take away everything besides the 5 minute velocity to explain this. So if we take a look at price action and we take a look at 5 minute velocity, there's an obvious story. So first of all, this right here is our most extreme 5 minute velocity print. This is when 5 minute velocity was the highest. Okay, and the whole thing about velocity, what it teaches you and everything, is price cannot remain moving in a certain direction if velocity does not support it. Okay, so that's very important to understand fully before diving deep into this tool. In order for price to keep moving in a certain direction, whether it be up or whether it be down, velocity has to keep making new highs with each new high that price makes, or velocity needs to be making new lows with each low that price is making. If price is moving higher while velocity is not moving higher, the move is false and it's running on fumes. So, for example, if you're pressing on the gas in your car and you're driving 30 miles an hour, even when you take your foot off the gas, so you were pressing on the gas right here, then you take your foot off, price is still able to move. The car will still be able to drift a little further, but it has to stop. It's not will it stop, will it not stop. It has to stop because you never put your foot again on the gas. And velocity tells us bulls never put their foot again on the gas. And so if that makes sense to you, what we do is we take the most extreme print, and we know that matter of factly, this is proven over the course of the year. Anybody who's paying attention, this has worked 100 out of 100 times. It has virtually never not worked. You do have maybe some of those instances where it doesn't, but if you're trading at 90%, you're still doing amazing. Anything over 50% is really amazing. So basically, what you're looking for is 3 new highs after velocity makes the highest high. So velocity made the highest high right here at 10:06, we'll call it. Okay, and price at that time was we'll call it 392. Okay, now right here, price makes a new high, and as you can see in the velocity clearly did not make a new high. So immediately right here, we're already saying, okay, I'm sus of this rally, because if this was a legit move, if this was indeed bullish, then I know velocity would have made a new high, because you can't see it here, but let's say price action started from 388. Let's say this trend up started from 388. So as price was moving up, velocity had been moving up as well. So everything was fine. Let's just draw it out. Let's say price was going like this, okay? And velocity, let's just say, was climbing up like this. So, price is going up, velocity is going up, everything's fine. All of a sudden, right here, velocity makes the highest high, and then price keeps moving higher, and velocity did not make a new high. So, we're a little suspicious right now of this rally. So the rule is, once you get this first new high, we'll draw it. This is false high number 1. Once price makes 3 new highs without velocity breaking above this red line that we have drawn, that's 3 bearish divergences, and we expect price to make a reversal. So right here you can see price made a new high, so we're going to draw this as number 2, and price came up one more time and made a 3rd high. And you could see, if we look at the velocity down low, you can see on this new high, velocity did not make a new high. On this new high, velocity did not make a new high. And on this new high, velocity did not make a new high. If anything, velocity had been trending down throughout the entire time that price was going up. And so this tells us, that the move is, there's no gas, no one's pressing the gas anymore on this move, and there's no more strength on the bull side, because if there was, the bulls were able to keep this going, velocity would have been higher than this original print. And so what you're going to find after this 3rd high is that you're going to get a reversal to the 5-minute trigger. This part isn't guaranteed, okay? This whole down leg, that's not guaranteed. But as soon as this new high happens, what is guaranteed is that price will revisit the 5-minute trigger, because where did the divergence happen? On the 5-minute velocity. So basically, if I'm long in this trade and I see this is the most extreme print, and then I see 1 new high, 2 new high, 3 new high, I'm always going to be out of my longs at this point. Now sometimes you'll get a move back to the 5-minute trigger, and then price will bounce, okay? And when that happens, you're more than welcome to get long again once price moves back above the 1-minute trigger. In this case, you may have gotten a little faked out, which is fine, happens. you didn't really have a full candle close above the 1 minute trigger, but price did revisit the 5 minute trigger, and that will always happen. Now sometimes price will move completely sideways in a bull flag while the 5 minute trigger comes up to meet price, and sometimes price will come down to meet the 5 minute trigger. So this part is important. If price after the third bearish divergence just drifts sideways like this, it just keeps going like this, and the 5 minute trigger comes up and meets price and it collides, 99% of the time price will bounce and continue higher. However, if price if after the third 5 minute divergence price comes back down to meet the 5 minute trigger, then it's already not as bullish, and you're scared of this swing down happening. So this is the 1 minute trigger, 5 minute trigger, and hourly trigger. This is just a quick example of bearish divergence on a push higher, price making new highs, 3 new highs while velocity did not, and then you see a visit back down to the 5 minute trigger. You also see the effects of price breaking under the 5 minute trigger because it starts a cascade move down. And another thing you can learn from this picture is that the most bullish trigger orientation is 1 minute trigger on top of 5 minute trigger on top of the hourly trigger. That is the most bullish. Now, we have no idea how long this move was bullish for. Could have been bullish for a week, we don't know, but as long as the 1 minute trigger is on top of the 5 minute trigger is on top of the hourly trigger, that's a bullish trigger orientation. And as long as you have that bullish trigger orientation, you could be long until you see your divergences. Now, when the 1 minute trigger crosses below the 5 minute trigger, you might get a move back down to the hourly trigger, but it's not bearish, it's just flat. So the bot, if you had an automated trading bot, when the 1 minute trigger is on top of the 5 minute trigger is on top of the hourly trigger, the bot will always be long. Right when the 1 minute trigger crosses under the 5 minute trigger, the bot will be flat. But we wouldn't go short yet because sometimes the 1 minute trigger will cross under the 5 minute trigger, but because price is above the hourly trigger, sometimes it'll cross right back and you'll turn bullish again. Okay, now let's take a look at what happened next. So we see price bounce off the hourly trigger and continue back up. So let's dive into this. First of all, we're going to take a look at hourly velocity. So as you can see, when price came back down to test this hourly trigger, hourly velocity was positive. And when hourly velocity is positive, we're always going to expect the hourly trigger to provide support. Now, why does this happen? This happens because bulls and bears, that are fighting, there's always one level that needs to hold for bulls to continue. Meaning, bulls don't need to hold this level at 390. Bulls don't need to defend here. Bulls don't need to defend here. Bulls don't need to defend here. However, if price would break below this point, for whatever reason, for however it's calculated, which we're not going to get into right now, maybe at a later session, if price would break under right here at 386.54, it would start a cascade downwards for bears because it is an emotional capitulation level for bulls. And so for bulls to keep the momentum, this is where they need to step in and defend it. The hourly velocity tells us how strong bulls are. So just by looking at hourly velocity, you can see the hourly velocity isn't that strong. So we wouldn't have known per se that price is going to bounce off the hourly trigger. What we have to do is we have to dig down into the lower time frames. So right now we're going to look at the 5 minute velocity and the 1 minute velocity, and we're going to see if we can learn anything from this. So we'll do one at a time because it's easier to see. So we'll start with the 1 minute. It's a really ugly color. Let's see if I could. Oh, that's a 3 minute. That's why. Okay, perfect. So let's bring this down. Okay, so right off the bat, not seeing anything on the 1 minute besides for right here. So if you guys look, you can see as price is coming down to the hourly trigger, price 1 minute velocity makes its most extreme low right here, -10, when price is up here at 386.94, and then price makes a new low, but 1 minute velocity does not make a new low. And so that is inherently bullish, because if it was bearish, if this push down was bearish, then 1 minute velocity would have made a new extreme low. It'll be more obvious, I think, when we turn on the 5 minute velocity. So as price is nearing the hourly trigger, what's happening with the 5-minute velocity? You can see that it's clearly getting better while price is coming down. Okay, so when you see these patterns, when price is revisiting the hourly trigger and 5-minute velocity is diverging bullishly.
Oh my god, why the fuck aren't my headphones working?
Okay,
I'm already missing out on everything. What?
it's recorded.
Okay, let's go higher.
All right, so again, as an analyst, when you're watching this kind of price action, this place isn't really where you want to be taking a position. You don't really want to go short once the 1-minute trigger crosses below the 5-minute trigger, because you don't know where along this path price is going to bounce. You don't really want to go long either, because you don't know if we're going to bounce over here, on the hourly trigger. But what you do want to do is you want to be paying attention to how the 5-minute velocity is behaving. If, as price pushes down to the hourly trigger, 5-minute velocity is getting more and more extreme to the downside, then as an analyst, you're thinking, I don't know if the hourly trigger is going to hold support, because bears look really strong as they're pushing this down. But look what really does happen. As price pushes down, price is making lower and lower lows coming to the hourly trigger. You can see the dip getting bought up so quickly in the 5-minute velocity. Looking at the 5-minute velocity, you can see that even though bears are pushing price down, what's really happening behind the scenes is that these dips are getting eaten up. Because if they weren't getting eaten up, it would have looked something like this. 5-minute velocity getting worse and worse and worse and worse and worse. But here is the most extreme print, right here. This it's negative 0.14, and price at the time was 388, and then price makes a new low, another new low, and during that time 5-minute velocity was getting better. So what that teaches us, what that shows us, is that bulls are stepping in and they're getting ready to buy all these dips at the hourly trigger. And so with confidence, once price hits the hourly trigger, think of it as an electromagnetic field. It's like the hourly trigger is where all the bulls are waiting to pounce on the bears. So sure, you can walk price down, we're buying the dip, we're eating it up, right? We're ready for you. And then as soon as price makes contact on the hourly trigger, then and you can see the 5-minute velocity, like bears are trying to smash through it. You can see a huge burst, but this part already told us the whole story. And the story that it told us is that bulls are clearly stepping in here to buy the dip, and then as you can see, you get the touch off the hourly trigger. So in this situation, the way you would play this is that you would go long after the first candle closes back above the hourly trigger. So when price dips below the hourly trigger, if you're a true believer, if you fully believe in the system, you can already start buying, because we know we had good 5-minute velocity divergence, and we know that the hourly velocity is positive. And so you definitely expect the hourly trigger to hold as support. But if you're not such a believer and you want a little more confirmation, then you watch price action, and as soon as a 1-minute trigger closes back above the hourly trigger, you go long. Think of it as like a trampoline, okay? And now a couple of things happen. So first of all, the 1-minute trigger comes up, and we call this a bear plane. So instead of the 1-minute trigger crossing above the 5-minute trigger, and as we know, the perfect bullish trigger orientation is 1/5 over the hourly. The 1-minute trigger instead bear planes off the 5-minute trigger, right here. So this is why you don't really want to go long. If you miss this long, you never really want to go long when price just breaks above the 5-minute trigger. You want to make sure the 1-minute trigger is crossing as well. So bears defend this attack of the bulls. They're able to bring price back down. A couple of fake outs right here. And watch what happens right here. The 1-minute trigger finally gets back above the 5-minute trigger. And at this moment, at 12:40 on Tuesday, January 10th, we know that we have the most bullish trigger orientation. 1/5 above hourly. So at this point, everybody should be long. There really isn't a reason to be short. Now, if you're playing this with, 0 date options, then as soon as you get one big move up, For me, 388 to 399, that's more than good enough for me. I'd take my profits somewhere around here. Um, or you can hold on to it if you want because price never broke below the 5 minute trigger. So when I'm playing 0 date options, my stop loss will always be the 5 minute trigger. So if I went long right here on this cross, this trigger cross, so I'm long at, let's say, like 388.60, you want to call it. As soon as price made this candle below 389.34, I would have been out. But let's see if we could have seen on the velocity before this dip happened something that could have warned us to get out of the long trade. So I remove hourly velocity again, and we'll just take a look at 5 minute velocity. So just looking at this off the bat, I could see something, very obvious. Hopefully everybody sees it too. As price was pushing up, there was no bearish divergence over here, okay? When there's no bearish divergence and price pushes up, if price comes back down to the 5 minute trigger, there's no reason to assume that it's going to break under, okay? And even if it breaks under, there's no reason to assume that it's going to stay under. As long as everything was healthy in the 5 minute velocity, so price pushed up, maybe this was a slight bearish divergence, but it's not meaningful unless there are three. And then price pushes up again, okay? Nothing too great on the 5 minute velocity, but on this new push, 5 minute velocity looks great. It's making price made higher highs, 5 minute velocity made higher highs than here. So this is called a false move. This is something you want to buy. As long as there was nothing suspicious in the velocity, then there's no reason to be scared when price makes this dip down. If anything, it's a great opportunity to double down. It's also a great opportunity to now introduce everybody to an airplane setup. I'm sure you've all heard me say this 100 times. An airplane setup is a powerful setup for bulls that occurs when price, 1 minute trigger, 5 minute trigger, is above the hourly trigger. So remember, everything's above the hourly trigger, and what you'll see is, you'll see the 1 minute trigger coming down to the 5 minute trigger, and then bouncing off. And that happens right here. So sometimes it'll come down a bit, but also think of it as like a trampoline setup. So, just in this scenario, there was two places to get long. You could have either got long on the first candle close back above the hourly trigger, or you could have gone long when the 1 minute trigger crossed the 5 minute trigger. Now, a lot of times when I'm trading, I'll just, especially in this market, because there's just no velocity anymore, there's no follow through in any moves. When I go long here, if I get this move up to the 5 minute trigger, I'm out immediately. 386.66, 388.40. It's a $2 move. My trades are usually $1,000 on SPY trades and SPY 0DT. So from this trade, I'd probably be able to pull out $400, and I'm very happy. That's a great day for me. And the whole trade was 10:46 to 10:59, 13 minutes. I make my $400. I'm pretty good for the day. A lot of times I won't even make another trade. Or for example, let's say I'd get long on this trigger cross. I'd be long about 388.65. I'd probably buy some like 389 calls. Either up here I would take profit, up here I would take profit, or any of these places I'd probably already be out. It's another couple $100. Like, that's really all I'm looking for in the trades that I'm taking now, which is why sometimes it's so hard to alert, because I'm really in and out. Because again, there's just no follow through in the market currently. But an airplane setup is a setup that'll almost always give you follow through, and it's already predetermined. Like, once you see it setting up, the algos are just ready to take price higher a notch. And so this is always an excellent opportunity to go long when the 1 minute trigger comes down to the 5 minute trigger and comes right up off it, and you usually see really nice powerful moves off it. Now again, if you were longing this, right, just like in general to be long, and you buy at the hourly trigger and you have calls a month or two out, it's so relaxing for you because your stop loss is just under the hourly trigger. So every hour that price is not under the hourly trigger, you're making money. So for example, if you like to buy contracts a month out or 2 months out, and obviously this is way better than buying zero data expiration. Usually I do like a combination of both. Like I'll decide on a long-term positioning. I'll have my calls for like further out, but I'll also be playing around short range. Currently I'm not doing that because there's too much uncertainty in the market, and although I'm bullish by nature, I'm not strongly bullish because every other day there's a new macroeconomic factor that can bring the market down. But for example, when things turn back to normal, or if you want to play this in stocks and equities, doesn't matter. If you ever go long above the hourly trigger, so you'd go long right here at 386, and you buy calls with enough time that you're not getting hurt by theta, you can stay long until price breaks back under the hourly trigger. In this case, it would have been right here at 396. So, and let's see how long it was. So this is Wednesday, January 18th, and you would have gotten long on Tuesday, January 10th. So in 8 days, SPY moved up $10, and you would have capitalized on all that if you have far date options. So when you're using this indicator and you're more of a safer player, less of a gambler, I'm way more of a gambler. I love to gamble, and this is the system I use to gamble. I'm not really trading per se. I'm trying to quickly take money out from the market very quickly. A lot of people like wouldn't agree with what I do, but it's been working for me. It does work for me. So, I'm not like that intently focused on like positioning and portfolio and everything. It's just like I know when I see certain setups, I can take money from these market makers, whether it's a couple $100 a day. Sometimes I get lucky, make a couple thousand. You know, if you are really patient and you wait for really great setups to occur, like just airplanes, or just buying on touches of the hourly trigger with a stop loss, let's say, literally 20 cents below. So you buy this area and your stop loss is right here. Your risk is so small. You could lose maybe a couple of bucks, but look how much you could gain. So if you just master these specific Nimoy setups, it's going to be very hard to lose long term once you master discipline and patience and not forcing things and not FOMOing into things and just waiting until the perfect setups to come to you. So if you want to treat this as a trader, you want to use this tool the best way possible, don't always follow just what I do with my quick trades, but use it for what it's meant to do, which is, you buy here and you sell here. That's a $10 move in 8 days, extremely profitable, and you never were in any risk of losing money because you buy here at 386.49. Your stop loss, let's say 386.20, so your maximum loss on a $10,000 investment, let's say, was about $300. And up here, you at least doubled your money, if not tripled, quadrupled your money. So on a $10 SPY move. So just such a great example of how this works by just using the hourly trigger. Now, for ODT, obviously, when you're really diving deep, that's when you can take advantage of the 1 minute trigger, the 5 minute trigger. But if you don't want to, if you're the kind of guy that likes to keep things simple, not get like overly intricate with everything, just use it as like an hourly trigger, like long above, short below. So for example, right here, again, you have to understand, this is only if theta's on your side, if you have plenty of time in your contracts. But you could have went short on the break below the hourly trigger at 396.17 and covered your short at 392. That's still a $4 move in Friday, Wednesday, in 3 days. Again, you could have gone long here at 392 and you would have got stopped out at 397. You could have gone long at 397 and you would have got stopped out at 402. So just playing the hourly trigger is strategy by itself. But today we got into the bullish and bearish trigger orientations. Here is when the trigger orientation turned bullish again with the 1 minute trigger on top of the 5 minute trigger on top of the hourly trigger. Here is an airplane setup, which tells us that continuation is coming. We also spoke about bearish divergences on velocity when price is pushing higher but velocity is not pushing higher. We also spoke about how to tell if price is going to bounce off the hourly trigger or not. And the way to do that is when price is coming down, if velocity is turning up while price is coming down, it tells us that buyers are coming in here to defend this hourly trigger, and you're most likely going to get a nice bounce. We also spoke about bear planes, which is when the 1 minute trigger rejects off the 5 minute trigger. That's usually bearish, especially if it's under the hourly trigger. And one more thing is, I'm sure everybody can understand, the same way 1 minute trigger above 5 above hourly is bullish, so too the hourly trigger above the daily trigger above the weekly trigger is bullish. And so when I look at the market these days and I